In the mid-quarter review today, we began a calibrated change in the exceptional liquidity measures we introduced in July by cutting the marginal standing facility rate, which is the effective policy rate today, by 75 basis points or 0.75 percentage points. We also reduced the minimum daily CRR balance that banks have to maintain to 95% of the requirement. We believe that easing the exceptional liquidity measures was warranted given that the external environment has improved and given that the government and the RBI have used the time since the measures were put in place to narrow the current account deficit and to ease its financing. The calibrated withdrawal will provide a boost to growth, reduce the financing distortions that are emerging in the market, and reduce the strain on corporate and bank balance sheets. We remain vigilant about external market conditions and will do what is necessary if they deteriorate once again. We've also announced an intention to return to normal monetary operations, where the repo rate will return to being the effective policy rate, and liquidity conditions need not be as tight as they currently are. Let me emphasize that the difference between the MSF and the repo rate will be brought down to 100 basis points. At the same time, recognizing that inflationary pressures are mounting and determined to establish a nominal anchor which allows us to preserve the internal value of the rupee, we have raised the repo rate by 25 basis points. The intent here is that when the repo rate becomes the effective policy rate, it should be consistent with inflationary conditions in the economy. On net, these measures will reduce the cost of bank financing substantially while allowing us to take an appropriately precautionary stance on inflation. Let me say that we do not have in mind what the next move should be on the repo rate. It will be tailored to economic conditions. The intent of this move was to ward off escalating expectations of inflation, but the pace of the disinflationary process has to be calibrated to the state of the economy. Let us remember that the postponement of tapering is only that, a postponement. We must use this time to create a bulletproof national balance sheet and growth agenda which creates confidence in citizens and investors alike. At the Reserve Bank of India, my colleagues and I have been busy developing the measures we announced about 2 weeks ago. Yesterday, the RBI implemented the full liberalization of bank branching with some safeguards to encourage inclusion. We announced both the FCNR-B swap facility as well as the swap facility for bank borrowings. I'm glad to say that the banks have started bringing in money. Till yesterday, we had received 466 million through the FCNR-B and 917 million through the swap facility for a total of nearly 1.4 billion in the 4 days that these facilities have been functional. We have started the process to issue two kinds of retail inflation indexed retail certificates, two kinds of inflation indexed retail certificates, one with a lump sum payment at the end and the other with indexed interest payments. We're still exploring the details of the structure, but we intend to issue these by November. We have set up the Central Credit Registry for large bank borrowers. The various committees we announced earlier this month are swinging into action. Over the next few weeks, together with the government, we will take a close look at corporate distress and bank NPAs to see how we can accelerate the process of resolution. Finally, we are taking a look at a variety of markets to deepen them and make them more vibrant. Measures will be announced periodically. Thank you.
When you ask questions, please announce your name, the organization that you represent, and then ask questions. Lata Dixit, CNBC TV 18. Governor Rajan, you said that you will anchor the repo rate consistent with the inflation rate, or you'll ensure the repo rate is consistent with the inflation rate. Which inflation? Will you look at WPI or CPI, and what will be the bias?
The RBI has always looked at both rates, and of course with CPI you could talk about CPI new, industrial worker, rural worker, etc. We have to take everything into account, because remember, the WPI inflation rate doesn't contain, for example, a significant portion of services inflation. So you can't just focus on one. But I think till we get the report from Dr. Urjit Patel and his committee, I would refrain from saying, we have a focus on explicitly on a particular measure.
Is there a bias?
I don't think there's a bias. I think the RBI historically has focused on a number of these. At certain points in time, one matters more than the other, but I won't say that it's a permanent bias.
No, actually, the next inflation reading on the WPI is likely to be higher. We normally start to see the Kharif rates, Kharif impact only in October, November, December. So would you say that the repo rate has yet to be normalized to inflation rate?
What we have to look at is what we believe inflation will be in the longer horizon. Typically, we look 6 months to a year ahead. So we have to look through temporary changes in inflation, which we believe will be corrected by, for example, crops coming in and so on. So we have to look through some of that. So I don't think one particular inflation reading will affect what we think our stance will be. It will be a variety of issues.
Ira?
Governor Ira from Financial Express. Just to follow up on that, what is the acceptable level then? Should we still work with the numbers that the RBI put out in the annual policy for this year, for instance? Do those numbers still hold on the inflation side, or has that changed?
Events over the last few weeks clearly have had an impact on what we think our forecast of inflation is likely to be, or is at this point, I should say. Take the rupee depreciation, take the at least temporary higher price of oil. We have to see if the oil price reduction sticks. These are all issues which will factor into inflation. And of course, suppressed inflation is also being let into. I think that's a good thing. It will be one-off. It will not permanently increase the rate of inflation. But those are factors which change inflation and change inflationary expectations. So we have to worry about some of those factors.
But Governor, just the point that I was trying to get at, so if one normalizes it back to the repo rate being the operational rate, and in the current context you're saying bringing down inflation to more tolerable levels has warranted an increase in the repo rate. So in the growth inflation dynamic that we're in right now, is this an anti-inflationary stance?
I wouldn't say that. Remember, during my remarks, of course we are anti-inflation, but during my remarks I said the pace of disinflation will be calibrated to the state of the economy. So clearly, if the economy continues to weaken and looks relatively weak, that will both give us a certain amount of cushion in terms of disinflationary processes at work, but also will give us an incentive to then perhaps look to putting greater emphasis on reviving the growth of the economy.
Sure. Anirudh?
Good afternoon, Governor. Anirudh here from ET Now. Like you mentioned that you feel that banks are overstating the impact of the CRR tightening that you all have done. Also in terms of, the kind of rate action that we've seen from a number of banks, including just yesterday we saw SBI raise their own base rate. Just like to understand whether you all feel that this kind of, firstly, reluctance on the part of banks to lend, and also the kind of the ease at which they're hiking their rates at this point of time. Is that something that concerns you all in terms of delivery of productive credit to the sector?
Let me put it this way. The MSF cut we've done today, 75 basis points, affects a significant quantum of funds that are borrowed from the markets through wholesale deposits, bulk deposits, and so on. And the 75 basis point cut there is actually a significant reduction in their cost of funding. Now, set against that, my sense was the 25 basis point CRR, the increase in the repo rate, is really inframarginal. It's going to affect basically the borrowing on the LAF. So the immediate effect of what we have done is actually reduce the bank's cost of funding. Secondly, if we can move reasonably quickly, again based on market conditions, of course, to a situation where we normalize monetary policy, you get away from the condition where short-term rates are at such a high level. A number of entities, I was talking to a financial institution yesterday, which largely borrows by issuing bonds in the market. And because of the increase in rates at the short end, they were forced to go and borrow from banks because they could no longer borrow from the markets. Those kinds of distortions will be eliminated. They will be able to return to market borrowing as we remove these emergency liquidity measures. So my sense is that to the extent that we can anchor inflationary expectations, we can create a sense of stability in the value of the currency by the repo, but at the same time be able to eliminate these or reduce these liquidity measures, again at a calibrated pace. The economy is actually better off from a growth perspective.
Clarification on this. Actually, when we spoke to bankers, they gave us perfectly the same explanation as you have given, that effective rate will come down. But if you talk to market players, they feel that MSF or the hike in MSF was a temporary measure and repo is a more permanent measure. So you have given a signal of short-term kind of easing and a medium-term tightening. Is that a misinterpretation you feel?
No, I think what you should look at very carefully is our language. We are watching economic conditions, and we will, when the repo rate becomes the effective policy rate, move it based on economic conditions. So, yes, economic conditions are evolving. Yes, there is an anticipation that the harvest will be good, that it will have a very moderating effect on inflation. Let us see how these play out.